15 minutes. Let's see whatever we can best cover. It is 11, 10, 12 we cover. Okay. There is a background to serial number 11. There is a lot of logistics service providers who provide end-to-end logistics solutions. Until the negative risk was introduced, okay, how are these services really provided? So you want to move some goods from Nasik to Cape Town in this example. You can go to this 3PL or third-party logistics service provider and you can tell him, I want these services. It's almost they have a menu. From that menu, you can tick which services. You can say, do the land transportation to JNPT, documentation, don't worry, I am a CHA. You take it, then you provide the ocean freight. Destination, I have someone in my office who will take care of documentation, but you do help with the customs clearance and land movement, So he gives you sort of a menu, you can choose. And there will be a price mentioned, the rate is mentioned over here against each of these. Now, prior to the introduction of negative risk, what all the logistics service providers, you are aware that these were getting taxed under different categories. And ocean freight was not taxed. Therefore, all logistics service providers took a stand that each of these line items is a separate service which is granted. And on each of these line items, they used to accordingly pay tax. Therefore, all the India services, they were not paying tax. They were paying tax under different categories or as business support services. Ocean freight, they said, is outside the purview of services, we need not pay tax. On the destination legs, some people took a stand that these are actually services performed outside India. Even though I am billing a customer in India, I will not pay tax. Some people took a stand that since I am billing a customer in India, I will pay tax. So some players were paying tax, some players were not paying tax. Thereafter, we had this question of the amendment to the business support service to say managing distribution and logistics. So there was a fear that if I treat it as a single transaction, managing distribution and logistics becomes a single transaction, and therefore, since I am billing an Indian customer, the whole leg, including ocean freight, will become taxable because I am not getting convertible foreign exchange. So, because of that, this particular interpretation was strengthened and applied to everybody across the board. Because you would never could afford to pay tax on ocean freight, it would become a very heavy liability. Now the problem is that with the introduction of negative risk, what should we do? Should we continue treating this as individual services, serial number 1 to 11? Or is it a composite transaction? If you see in your paper book, when that composite transaction $15,000 is for the whole, it covers all one price, one consideration for 1 to 11. It's not separate only for one. I think while printing those boxes have appeared, it's actually one composite fee. So whether you should treat it as one transaction or you should treat it as independent transaction. If you treat it as a single transaction, you can say it is a transaction in respect of transportation of goods, which is taxable according to the destination. Destination is outside India, I don't need not pay tax. If I don't receive convertible foreign currency, it becomes an exempt service. But without an amendment to your contract, without an amendment to your style of working, will you now suddenly be able to say these are not 11 transactions and not only one transaction? If I suddenly change your stand, you will also be exposing yourself for the past, where they will say, why were these not a single transaction in the past with the business support services, managing distribution and logistics? So unfortunately today, also, many companies have continued this particular stand to treat this as independent transactions. Because there is an exposure to the past. At that one point in time, there was again the question of whether we could apply section 66F and say that although there are 11 different pick and choose items which is done, it's all bundled into one. But here again the question is, and there is a doubt, that when does 66F come into play, as in bundling? If I have 11 line items with 11 separate considerations for each, and there is no interplay between them, and I am not charging more and less for the, I can pick any one of the 11 or all of the 11. Then can I say this is when I am picking and choosing all the 11, then there is actually a bundling or not? Now to my mind, the concept of bundling will come into play only when there is a single consideration. When you are having an option of picking and choosing a service which you want or you don't want, and a separate consideration provided in your menu, then to my mind, you cannot say that just because I am billing you for 11 activities which I have done or 11 things which I have done and therefore there is a separate consideration, it is a bundled service. To my mind, these are 11 services. Only when I am having this 15,000 as a single consideration and I say I will pick up from Nasik, reach it to Cape Town, then it's a bundled service for the various activities I have done. So that is the way I am interpreting section 66F. Now, looking or interpreting this, if it is a single transaction, then clearly you will be out of the service tax net, there is no liability. But what happens if all of these are independent transactions or independent services? And let's quickly run through them. Serial number 1 to serial number 5. These are all what is called origin-based services. All services done in India from the factory to the port. 6 is ocean freight. 7 to 11. 7 to 11 are all destination-based services, which are all done outside India, performed outside India. So if I can quickly run through these. Land transportation from Nasik to JNPT. Okay, before I go, maybe we can quickly run through the rules. Rule 3 is the general rule, which is recipient-based. Rule 4 is the services in relation to goods, where the goods are required to be physically provided to enable the service, provided to provide the service. Loading, unloading, transportation, loading, unloading, packing, unpacking, all those kinds of services. Rule 5 is for immobile property. Rule 6 is for events. Rule 7 says that in respect of Rule 4, 5 and 6, services of Rule 4, 5 and 6, you pay tax in the location where the maximum work is done. Rule 8 says that whenever services are provided, Rule 4, 5 and 6 services are provided by, where the service recipient and the service provider are in India, then it shall be the location of service recipient, which is again going to be India. Rule 9 is the special services. Rule 10 is the transportation. Rule 11 is for transportation of goods. Rule 11 is transportation of passengers. So if I look at rule serial number 1, land transportation, it is a Rule 10 service. Destination is JNPT, within India, becomes taxable. Cargo handling, it's a Rule 4A service because I need to make the goods physically available to enable the service provider to handle the cargo. 2, 3 and 4 are all Rule 4 services and therefore again clearly taxable in India. Documentation charges at the port of origin, which is India, are again it's a Rule 3 service, but since my service provider is in India, it's going to be obviously taxable. Ocean freight is a Rule 10 service.
So if item 1 you said is Rule 10.
Rule 10.
And taxable.
Yes. Ocean freight is Rule 10. Destination outside India, therefore not taxable. Cargo handling at destination ports, stuffing, destuffing, loading, unloading. Again, these are all Rule 4 service. Rule 4 is outside India. Now that is where you have a problem. Rule 8 comes into play along with this, which says where the service provider and the service recipient are in the taxable territory, then the place of performance will be the place of provision of the service will be the location of the service recipient. So since I am going to build an entity in India, although it's a Rule 4 service and it is done outside India, Rule 4 read with Rule 8 makes it a taxable transaction.
All this
7 and 9. Rule 10 again is a serial number 10 is again a Rule 3 service. You billing someone in India, you need to pay tax. Serial number 11, land transportation from Durban to Cape Town. It's a Rule 10 service. Now you have Rule 8 and Rule 10. But Rule 14 says whenever two rules come into play, the later has to apply. Right? So Rule 8 is there, Rule 10 is there. So although I am billing an Indian entity, in view of the fact that it is destination based, Rule 10 will survive, where the destination is outside India and therefore not taxable. So serial number 11 is not taxable. This is the kind of difficulty you are having, and therefore all these 3 periods are finding it difficult to discharge the liability. Some transactions suddenly become taxable, not becoming taxable. Now, so long as this case study goes one step ahead to say that so long as the destination-based services are concerned, the Indian service provider will not perform this. He will get somebody to perform this from outside India. So he's going to pay part of that consideration towards service provided outside India. And what happens to those services? Does he have to pay tax? Again, if you look at rules 7, 8 and 9, rules 7, 8 and 9 are again rule 4 services. There, rule 8 doesn't come into place because the service provider is not in India. I am the service recipient, or whoever the package is the service recipient. And therefore, on the expense side, it's not liable for payment of service tax under the reverse charge because it is performed outside India. Are you with me or are you not tired?
Excuse me.
Yes.
The rule 10 is not the destination of goods. It is a person liable to pay service tax. Transport.
Transportation, GTA.
11. It's 11.
You are number 11. Yeah. So 11 what happens? Movers and packers is not going to issue a lorry receipt.
On very first number only, it stated that rule 10 it is a destination of the goods. It is not correct actually. For transport, it is person liable to.
Okay. Sorry. Let me clarify this. When a 3PL provides services, 3PLs are not transporters. So I have gone on that assumption because they will not issue, they will engage a transporter and they will engage various entities to perform these 11 activities. They will themselves not be transporters. So a 3PL will engage a transporter to move it to JNP. He will get a reverse charge. But when he bills, he will have to again pay tax. That is the assumption and that is the structure of the transaction. And that's why I am not considered GTA.
But if a transportation of goods by road is again exempted by the either negative or mega exemption. If you are not ETA, then the transportation of the pure by the road.
Then there is an
exemption.
Yes, I understand.
Negative.
Correct. There is an exemption in the negative. So it's a rule 10. However, there is an exemption. I stand corrected to that extent. There is an exemption in the negative. I'm sorry, I'm running a bit. We have got up to about 5 minutes now. Rule 10. When I am engaging a foreign entity, serial number 10, when I am engaging a foreign entity to help me with the customs clearance or the documentation charges, these are rule 3 services. And therefore, whatever he charges me, I have to pay under the reverse charge and claim a separate credit and bill my customer in India. Similarly, land transportation from Durban to Cape Town, again, it's going to be destination outside India. So when that person charges movers and packers in India, they are not required to pay under the reverse charge at all. Because the destination is outside India.
Or because of the mega notification serial number, he said. Both also.
Or both. Whereas serial number 10 anyway goes out. Rule 10 anyway goes out. I said correctly. Thank you, Narendra, on that. So we'll take serial number 12. And I think we might have to close after that. Serial number 12, quickly. So issue 1 is really whether the out-of-pocket expenses which are reimbursed forms part and parcel of the consideration or not. We have this decision of Intercontinental where they have said that the out-of-pocket expenses for air travel and hotel obviously will not form part of the consideration. They are not cannot be considered as gross amount charged for the services and therefore not liable. Now, to my mind, while Intercontinental is correct in its own way, to my mind, you also need to bear in mind how your agreement is structured. Does the agreement make it obligated on the part of the service recipient to arrange for everything, which is to say, for example, I am a chartered accountant providing an auditing service in Mumbai, and I say I will provide his auditing services in Mumbai. He has a factory in Ahmedabad, and therefore he needs to go to Ahmedabad by flight and hotel, and I say I will only charge you 1 lakh rupees for the audit fees for all the work to be done here. Anything traveling is your headache, you arrange. If he tells me to arrange, then I will arrange and claim a reimbursement. To my mind, I can then take a stand and apply for Intercontinental to say that yes, it's not liable for payment of service tax. The other way is that if they say it's 1,25,000 rupees, you have to arrange everything. Then, if I charge it, then it is my responsibility coming within the scope of my services that I will also include 1 trip or 2 trips to Ahmedabad for the purpose of the audit. And then if I say, okay, I will give you 1 lakh rupees and 25 separately based on my submission of my vouchers, then to my mind clearly it has to be added. So again, if you want to really get into this argument of whether it should be taxed or not taxed, it's going to be how you are going to word it. And you need to word it in such a way that it is not an obligation or not required to be arranged by the service recipient, service provider. It has to be the obligation of the service recipient. Only then you will be able to go out of this particular liability. practically, as most of us really, the nature of the services we provide and many other consultancy services, it's very difficult to document what is to be done and not done, and therefore you always get into trouble. So practically what we always do is always continue to levy tax and not perhaps follow intercontinental.
And I am also not sure it is fully correct also.
There is, yes, doubts have been, yes, doubts have been expressed.
Judgment is not fully correct.
Okay, so that is, as you concerned, is not fully correct. So I would at least advise that practically continue levying the tax. Please don't stop. The issue has also come, and I also saw a recent matter.
Except when you book the client's ticket, the UK judgment says, client's ticket you booked and got reimbursed, that you will not.
That will not tax.
But your ticket you go to Amsterdam, your London solicitor going to Amsterdam, which is the client's premises, clearly considered for service.
Is workable. But sir, what if my services, I was obliged to provide a service?
Whichever way you cut it.
Otherwise, they say it's taxable.
If he buys tickets and gives it to you, it may not add it.
There is no question.
But if you recover from him, separate item, this item, etc. I'm interrupting because it may personally affect you. That's the reason I'm saying.
Very important.
Forget about the clients. Our first interest is.
Almost. Yes.
Your service starts when you leave your home.
But if I'm obliged to provide service in Mumbai,
That's a
then
term of
he's asking
service.
me to go as a term of service.
So
There will be disputes, and therefore, yes, you might have to.
you proceed on the footing intercontinental doesn't exist.
Doesn't exist.
At least in your personal affairs. Past defending is one. For future planning
Is different. Now the other situation which has arisen recently is that where there is a foreign management consultant who has come to India for a work. I arranged their hotel in India and they travel. The department is saying that if he had arranged, you would have paid reverse charge, you also add this for payment of reverse charge.
That's perverse.
So there again we are going to one step further to say that even the expenses which you as a service recipient incur, you need to add it back. So that was the background for, I thought we should have this short discussion on this. At least to the extent of foreign service provider, for reverse charge purposes, expenses incurred by us in India obviously will not be required to be added. The other issue 2 and issue 3 are in respect of work undertaken by a branch or a liaison office. Now we have a situation where branch is having various expenses on its own, and and the head office in India will remit some funds to enable the branch to meet its expenses. The question is whether these would be in the nature of services and the head office needs to pay reverse charge on these services or not. Also, the branch may be serving some of the customers of the Indian entity, and therefore the question is, to that extent at least you need to pay reverse charge on tax on the reverse charge account. Now, so far as the branch expenses in this issue number 2, serial number 1, which is operation expenses of salary, cost of the employees and office rent, and other expenses exclusively required for the branch operation. To my mind, these are actually expenses incurred by the branch for its own existence, and even if money is remitted, when money is remitted, this is only actually a funding requirement, remittance of money on which there will not be a liability for payment of service tax, and there cannot be a reverse charge liability now. So I'm quite clear about this. Even otherwise, I will have an alternative argument to say that if you want to invoke the provisions of reverse charge, then there has to be receipt of the service in India. Even under the earlier import of services rules, also under the present reverse charge, it talks about receipt by a person in taxable territory. Now here is a situation I will say that all the services which a branch has received have been received by them, have been consumed by them. And I have not received, I am only remitting money to enable them to meet their expenses. There is no receipt of services in India, and therefore to my mind I will not want to levy tax on this or not pay tax on this. Now what happens in a situation where the branch is serving some of my clients? So say I am a management consultant, I am having a client in the UK, and for the UK client I have a contract for providing some management consultancy services for say £100,000. Out of this, I ask my branch to depute some of the people on site who will work at the office of my client. And say the extent of the work done by the branch is going to be say worth £40,000. So £60,000 worth of work is done by India, £40,000 is work done by UK. And I will from India raise an invoice for 100,000. Now the question is that what will be how do we value the services? Is there or there are two ways of looking at it, that India has provided services worth 60,000, the branch has provided services worth 40,000, or the other way of looking at it is that whenever the branch has done the work, they have done the work done for India, and therefore India has received the service undertaken by the UK branch. India should pay a reverse charge, and then when they bill 100,000 to the UK customer, the 100,000 will be an export of service on which they will be entitled to claim an export benefit of export of service and therefore a corresponding refund. So this sometime back was discussed in the decision of Tech Mahindra, I think in March 2013, where it was a limited point in the context of export of services, and prior to 27th of February 2010 and after. What the Mumbai Tribunal said is prior to 27th of February 2010, we had this condition which said provided from India and used outside India. And here was a situation where the UK branch, there was a customer of Tech Mahindra India. They had a branch outside India. Some work was done by the branch, some work was done by India. And they said that a branch, in this example, just to take an example, a branch did 40,000 pounds of the work, India did 60,000, they claimed an export benefit of 100,000. So say, I received 40,000, they paid a reverse charge, and then they claimed an export benefit of 100,000. The tribunal said that the condition for export sales provided from India and used outside India up to February 2010. To the extent of the work done by the UK branch, this was actually provided from UK and done used in UK, and therefore you cannot get the benefit of export. Your export is only to the extent of 60,000. Of course, then they also have made a mention to say there could be another question which will arise, that if that service of 40,000 was done in UK, from UK to UK, then I shouldn't have paid reverse charge. They said, but this argument was never made. This argument was never made at an adjudication stage, so we keep it out. That means effectively that money they might have lost it, because the 1 year time bar may have gone. And now to say that this export benefit is not available. So that is one way of looking at it. Well, the way I interpret this, and I have a slightly a view which is a little different than the tribunal's decision. I felt that now that we have the clear provision which says the branch and the head office will be treated as distinct entities and for distinct establishment, even when a branch is undertaking any work in respect of a contract undertaken by the head office in India, this should be treated as services received by India, pay the reverse charge, and then claim it as an export. So I think that would be a better way to treat this transaction so as to complete the circle. Of course, the other way of looking at it is to treat it the way the tribunal has held, that you take it as only split the two turnovers into 60-40 and say India export only services worth 60 and 40 is an out-and-out transaction. But my interpretation is that is going to be a better interpretation to take in terms of the compliances. Thereafter, the question was the tribunal also discussed the situation post February 2010, and you recollect in February 2010 they deleted the condition provided from India and used outside India. There they said that since this condition is gone, your export is worth 100,000. Now again, that is a dichotomy, or I would say a deviation of the tribunal. That if in the first case you say service never came in to go out, just by changing a condition, how do you say service now came in and went out? Because the service remains a service. A place of provision will remain a place of provision from to. Just by changing one condition, you cannot now change to say just because a bill from India, I provided from India. In that case, even after February 2010, they should have taken a stand that yes, going by the logic, you still have to pay, get an export benefit only on 60,000 and not over to 100,000. But there again, they have stepped forward, and then I would say somewhere created a disconnect by saying now with the deletion of the condition, you can now claim a full export benefit of $100,000 in the example I gave you. So again, they have gone a little beyond this aspect. But I feel that considering this should more appropriately be treated as a receipt of service in India and an export from India. Going to the issue number 3 in the same case study is a similar situation, but the question is in respect of a liaison office. Now friends, what has happened is why this liaison office issue is now suddenly creating a problem is everywhere when we look in the early provisions as well as the new provisions, which they talk about treating the the establishment, Indian establishment and the establishment outside India as distinct. They have somewhere brought in the element of business. So if you look at the definition of service, I'll quickly take you through explanation 3, 3b. Since an establishment of a person in a taxable territory and any of his other establishment in a non-taxable territory shall be treated as establishments of distinct persons. That's fine. Explanation 4. A person carrying on a business through a branch, agency or representation office in any territory shall be treated as having an establishment in that territory. So here again they are saying business. If I am not undertaking a business, then I am saying you are saying it's not an establishment in that territory. And that was similar was the word if you turn a few pages under section 66A. 66A up to 2012.
Same page.
Sorry, same page. For me, the next page, sorry. It says where the provider of the service has his business